Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 8. And Chapter 8 is all about costing systems or the marginal contrasted with absorption costing. And in this lesson, there are three key areas that we're going to be discussing today. First, we have the introduction. Second, we have the financial statements under financial accounting. And finally, we have financial statements under managerial accounting. Now, chapter 1 introduced financial accounting as a major component of management accounting. In chapter 3, financial and management accounting are distinguished. These discussions in the previous chapters are preliminary to this chapter's discussion. And it's been previously stated as well that the baseline for both financial and managerial accounting is the historical value of the transactions, as this is the basic in accounting. But as far as report generation is concerned, management accounting is evolving. It no longer allows the recently adopted standards by the financial accounting, which is the International Accounting Standards. While it is true that management accounting is a little bit affected because the entrance of international accounting standards, the values, culture, and the accounting standards of other countries are also put into consideration. Generally, management accounting is governed by the rules of the management, which are, or who are rather, the user and the decision maker. So as a start of this chapter, the financial statements are prepared under financial accounting. So this will be the second key area that we're going to be highlighting. We will be highlighting now financial statements under financial accounting. So the income statement, as you can see on figure 8.1, this is the income statement under financial accounting. So the income statement of Alpha Manufacturing Company as shown is prepared under financial accounting. And please take note of how it was prepared, because after this presentation, the perspective will shift to financial statements prepared under managerial accounting. Now, in our previous chapter's discussion, we learned that the first step in generating an income statement is first, there should be a name of the company. So in this case, the name of our company is Alpha Manufacturing Company, followed by the name of the statement. So in this case, the name of our statement is income statement. And then it should be followed by the duration or period. So in this case, we have for the period ending December 31st, 2012. So as you can see, or as you can recall in our previous discussions, if we talk about income statement, there are only two keywords that we should always remember. First, we have the revenues, and second, we have the expenses. So revenues less expenses, that would be your net income. So in this case, our revenue account, which is appearing first in our income statement, as you can see, that is sales, right? And our sales, as per Schedule 1, we have 1,500,000. And it is deducted by the cost of sales as per Schedule number 2. So we have 995,312 and 50 cents. Therefore, our gross profit is 504,687 and 50 cents. And remember, our revenues should be deducted by the expenses. So in this case, our expense is our operating expenses, which is 450,000 pesos. And therefore, our net income is 54,687 and 50 cents. Now, question, how did we arrive with the net sales 1,500,000 pesos? How did we arrive with the cost of sales 995 and 312 and 50 cents? And how did we arrive as well with our operating expenses 450,000 pesos? Now, in order for us to know about it, I will be showing you the supporting schedules for these financial accounting. So as you can see on figure 8.2, this is the schedule of sales computation. So you have their gross sales 1,560,000 pesos, less your sales returns, sales allowances, and sales discounts amounting to 60,000 pesos. And therefore, we arrived with our net sales of 1,500,000 pesos. On the other hand, in figure 8.3, this is the schedule of the cost of goods sold. So this was how the cost of goods was being calculated. And as you can see, the factory costs, we have 995,312 and 50 cents. So that is where we get our computation for our cost of sales, 995, 312 and 50 cents, which is reflecting in our income statement report. On the other hand, for figure 8.4, as you can see, this is the schedule of operating expenses. So all expenses that are related in our operations, so the total, that would be 450,000 pesos. So that is where we had, or we get the computation rather, of our operating expenses. Okay, so this is how we actually generate income statements using financial accounting. So this is how we generate income statement under financial accounting. Now, the formats shown from the income statement to these supporting schedules are in accordance with the Philippine Financial Reporting Standards, or the PFRS. On the face of the income statement, only line items stating the reference on the specific schedule in the notes to the financial statements where the details of line items can be found are shown. Now, the second key area that we're gonna be discussing right now, that would be financial statements under managerial accounting. So how do we generate then an income statement under managerial accounting? Now, the financial statements under managerial accounting shall be divided into two parts for purposes of presentation. First, we have variable costing approach, and second, we have absorption costing approach. Now, what's the difference between the two? If we say variable costing approach, it is a cost accumulation and reporting method that includes only variable production costs, such as direct materials, direct labor, and variable overhead as inventoriable or product costs. On the other hand, if we see absorption costing approach, it is a cost accumulation and reporting method that treats the cost of all manufacturing components, such as direct materials, direct labor, and variable and fixed overhead as inventoriable or product cost. Now, the basic difference between the two approaches is the fixed and variable components of the amounts shown in the income statement. Now, if we say fixed costs, these are the costs that remain constant irrespective of the volume of production or sales that a business may have throughout a period. Examples of fixed costs are rental expense and advertising expense. Now, in order for us to better understand why these two expenses are some of the many examples of fixed costs, so it can be best understood by providing an example. So, for example, a business is renting 30,000 pesos per month for its production area. If the production during the year is 500,000 units, the rental for the whole year is 3,600,000 pesos, which is calculated by means of having 30,000 pesos per month multiplied by 12 months, since there are 12 months in a year. So how about if the production during the year is 750,000 units? how much will the rental expense be? So the answer would be 3,600,000 because rental expense is a fixed cost. Meaning to say, when we say fixed cost, these are costs that remain constant irrespective of the volume of the production. So even if you manufacture or produce 1,000,000 units, you still have the same rental cost, okay? So another example, the business has paid an annual advertising expense of 4,500,000 pesos. During that year, the sales of the company has increased from 30,500,000 pesos to 38 million pesos. How much is the advertising expense of the company during the year? So the answer is 4,500,000 pesos because advertising expense is a fixed cost. It will never change regardless of the volume of the production or sales. On the other hand, we have variable costs. And if we say variable costs, these are the costs that varies with the production or sales of the business. One example of this one is direct materials. Why is that so? Because direct materials cost will increase as production increases because more materials will be used in the increased production. Another example is direct labor. And why direct labor? Because just like direct materials, direct labor will vary with the increase in production because the more products are produced, the more labor is used as well. And finally, we have commission expense. Commission expense is an example of variable cost. It's because the higher the sales, the higher the commission expense. And commission expense is considered as a variable cost. And finally, we have semi-variable cost. If we say semi-variable cost, it has a fixed and variable components. And these are the costs or expenses that are fixed for certain levels of production or consumption, and thereafter becomes a variable and vary with production or sales. Example of semi-variable cost is electricity expense. Why electricity expense? It is because for the first few kilowatt hours used, it is fixed. However, in excess of the fixed, the charges varies. So the more kilowatt hours are used, the higher the charges. Now, since semi-variable costs are comprised of fixed and variable components, these components must be separated. And therefore, we will be making use of high-low method, okay? So the following, as you can see on figure 8.5, you can see there a sample computation of separating variable from fixed costs using high-low method. Now, the following are the volume and corresponding total factory overhead costs for the past 8 months. As you can see there, you have months 1, 2, 3, 4, 5, 6, 7, 8. And this is from Grand Lecas Corporation. And the high-low method is used to split the company's total factory overhead into its variable and fixed components, as you can see on our sample illustration there. As you can see there, you have months, followed by units, and followed by factory overhead. And below that, you can see at highest activity and at lowest activity, because remember, this is high-low method. So we need to get the highest activity and the lowest activity in this particular example. And you also have, since we will be separating variable costs and fixed costs, as you can see there, there is also a computation of variable costs and fixed costs as well. Now, under this method, we can compute the variable cost per unit as follows. So there are certain steps that we need to strictly follow in order to make use of this method or high-low method. So step number 1, get the highest total number of units from the sample period, okay? So going back to our figure 8.5 to be specific, if you try to run your eyes from months 1 to 8 and the number of units produced as well. So since we will be tasked to make use or to get the total number of units from our sample period, the highest total number of units. So as you can see there, at month 7, we actually manufactured or produced the highest number of units, which is 3,000 units. And its corresponding factory overhead is 59,000. So that is our step number 1. And step number 2, get the lowest total number of units from the same period. So if we try to go back to our illustration, as you can see on month 2, we were able to get the lowest amount of our production. So we only produced at that time 1,250 units with its corresponding factory overhead 38,000. So that's step number 2. And step number 3, we need to get the difference of the unit cost. Now, as you can see there, that is our step number 3. So the unit cost difference, so we actually deduct 59,000 to 38,000. So that's step number 3. And step number 4, get the difference of the number of units. So as you can see, we also get the difference of the total number of units or the number of units based on our highest and lowest activity. And finally, for step number 5, we need to divide the result of step number 3 with the result of step number 4. So in the example, 21,000 pesos divided by 1,750 units is 12 pesos. And this is the variable cost per unit, as you can see there in our illustration. So computing the fixed cost at highest level, you have their total cost in a certain period amounting to 59,000 pesos, less the variable cost, which is 3,000 units at 12 pesos per unit, amounting to 36,000, and therefore the fixed cost is 23,000 pesos. On the other hand, computing the fixed cost at lowest activity for period number 2. So as you can see, total cost for period number 2, that's 38,000, less variable cost of 1,250 units at 12 pesos per unit, so amounting to 15,000, and therefore our fixed cost is 23,000. And so for that matter, as you can see, they are balanced in regards or with respect to the highest activity and lowest activity. Now, the income statement prepared under the financial accounting can now be converted into an income statement prepared under managerial accounting, where the cost accumulation is the same but could be presented differently. Now, the following are the steps to be followed in converting the financial report above into a managerial accounting report. See, these are the following steps to be followed in converting the financial report into a managerial accounting report. So what's step number 1? So for step number 1, we need to identify which are the variable and fixed cost components in the income statement. Remember that variable costs are costs that varies with production. So the higher the production, the higher the cost. On the other hand, fixed costs do not change regardless of the production. So as you can see, this is figure 8.6. So this is a schedule of cost of goods sold with identification of cost classification. So as you can see there, it was clearly identified. As you can see on the last column, you have there cost classification, and we identified each of the accounts as to whether it's under variable cost and fixed cost. So as you can see there on our result, our direct materials, direct labor, indirect materials, we also have indirect labor and other fixed overhead. Those are under variable costs. On the other hand, our fixed costs are, we have depreciation, we have rent, and we also have other fixed overhead, okay? So again, that's step number one. We need to identify which are the variable and fixed cost components in the income statement. On another example, under Schedule 3, operating expenses, each of our expense accounts are also classified according to whether it is under fixed cost or variable cost. And as you can see, our fixed costs are salaries and wages. We have rent, we have depreciation, and we also have miscellaneous. And on the other hand, we have classified utilities, commission, office supplies, store supplies, taxes and licenses, and transportation as our variable cost. And step number two, after plotting the variable and fixed cost components, a variable costing income statement can now be prepared, which is used in the industry for a specific purpose. So this is an example of figure 8.8. This is the summary of our cost classification. Again, as you can see there on the first column, you have their manufacturing costs, and you have their total, you have their variable cost, and you also have their fixed cost. And as you can notice, our variable cost is amounting to 239,400 pesos, and for fixed cost, we have 210,600 pesos. And under the absorption costing approach, the cost of sales represents the variable manufacturing cost and fixed manufacturing cost. The difference between the sales and the cost of sales represents gross profit. And finally, the operating expenses represent the variable operating expenses and the fixed operating expenses as well. On the other hand, under the variable costing approach, the cost of sales represents the variable manufacturing cost and the variable operating expenses. Second, the difference between the sales and cost of sales represents our contribution margin. And finally, the operating expenses represent the fixed manufacturing cost and the fixed operating expenses. Now, as you can see on figure 8.9, this is an example of a comparative income statement of absorption costing and variable costing method. So as you can see, we are able to see the difference between the computation of absorption costing method and variable costing method. And if you go down to the net income portion, for absorption costing method, the net income is 54,687 pesos and 50 cents. On the other hand, with respect to variable cost method, we actually arrive with the same net income amounting to 54,687 pesos and 50 cents. And as you can see on figure 8.10, this is an example of comparative income statement with cost computation. So this is similar to figure 8.9. This is just an additional example showing the cost computation. So be aware that there is a difference between the two methods of income statement presentation under managerial accounting. Now, the main reason for this is the treatment of inventory costing. Take note that under the absorption method, variable and fixed manufacturing costs are the elements of inventory cost. On the other hand, under the variable costing method, variable manufacturing costs and variable operating expenses are components of inventory costs. Now, what do these information indicate then? Now, this means that the manager should be cautious about the amount of variable and fixed costs, as this serves as the base of inventory costing. It must also be remembered that the higher the inventory ending, the higher the income, And the lower inventory ending, the lower the income. So it is a manager's decision. All right, I think that's a good place to stop. If you have questions, please let me know on the comment section below. And if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.